You know, when it comes to setting up any business, whether it's property, whether it's Amazon FBAs, whether it's YouTube automation, whether it's drop shipping, there'll always be an element of risk involved, and that's fine. That's part and parcel of being an entrepreneur. Ultimately, it's why we get started in business, because we want more in life, but we also have to accept that as part of doing that, there'll always be an element of risk involved. So by way of example, a dropshipper who sets up an online fulfillment company will always have that risk of either products arriving faulty, returns because customers don't like the product, and ultimately that's cost for the business. But again, that's part and parcel of being an entrepreneur. The key in all of that really is, how do you manage that risk, and ultimately at an individual level as the business owner, how much risk are you willing to take on? So in today's video, what I'll really cover off is, how do you set up a business within property, and more specifically, how do you de-risk setting up the business for yourself when it comes to dealing with clients, when it comes to dealing with investors, when it comes to dealing with any stakeholders involved in the process, whether it's estate agents, whether it's solicitors. And I guess one of the key arguments I'll present in this video is why it's really beneficial to set up as a limited company, but on top of that, understanding how it can be beneficial from a tax point of view. When it comes to property, if you're dealing with the buying and selling of a property, as most of you will know, there's risk within that process. And ultimately, as people who own a business, we have to ask ourselves the question, how do we de-risk that situation for us? This is ultimately one of the biggest reasons why you'll hear the difference between sole trader and limited company. So when it comes to setting up any company, but particularly in property, the preference is always to lean towards setting up as a limited company. Now, there are quite a few reasons for this. So when we say limited company, what we actually mean is limited liability. So let's say, for example, if you're running a property company and for whatever reason the company goes into administration, what that means is that you can then file for the company to go into administration, but your personal assets aren't at risk. So for example, your home, your car, any tangible assets that you physically own won't be put at risk if you operate as a limited company. Any debt simply gets written off for the limited company. Whereas comparatively, if I was a property investor set up as a sole trader, I have unlimited liability, which means that if the company does go into administration, my personal assets, my house, my car, any other assets that I own that are of value would be put at risk and would potentially have to be repossessed to pay off that debt. Now, when it comes to the other benefits of being set up as a limited company compared to a sole trader, I made reference to the tax system within the UK. So for those of you who aren't aware, within the UK, depending on how much money you earn, that will dictate how much tax you need to pay. So £12,500 is basically the minimum amount where you don't need to pay any tax. Anything after that amount, roughly up to around £50,000, you will fall into the 20% tax bracket. So anything you earn is 20% tax deductible. Anything over £50,000, you will fall into the higher tax bracket, which is basically 40% tax deductible. Now, if you are set up as, let's say, a sole trader within property, you have a day job where you're earning, let's say, £35,000 a year, then for your day job, you obviously taxed it 20%. However, any revenue that's incurred as a result of operating as a sole trader within property, if you earn anything over £15,000 in this example, you will fall into the higher tax bracket, because anything the company earns as a sole trader is directly tied back to you at an individual level. Now, if you are set up as a limited company, then technically the company exists as a separate entity to you as a person. So if the company, let's say for example, was to incur £20,000 in revenue, then at an individual level, you would still be taxed at 20% because you exist as a separate entity to the limited company. And this is a great way to avoid falling into the higher tax bracket at an individual level, particularly when you're starting out in property. And let's be honest, for most of us, we work a day job and then we do property investing on the side. Okay, hope you guys found that video useful and insightful. As always, do hit the subscribe button. If you do have any comments or queries, again, just post them down in the comments below. And until then, see you guys next time.